South Korea, with a population around 52 million, is a highly developed economy achieving a GDP of 1.869 trillion in 2024. However, political instability, including the impeachment of its president and prime minister, slowed economic growth to just 0.1% in the fourth quarter. Despite these challenges, South Korea remains a global leader in the key industries, semiconductors, and technology. To mitigate external pressures and sustain growth, the government has pledged 360 trillion in policy financings to bolster exports and support strategic sectors. The Korean won was introduced in 1945, replacing the Japanese yen. After facing hyperinflation, it was replaced by the won in 1953, then reintroduced in 1962. The won stabilized and adopted floating exchange rate after the 1997 crisis, symbolizing South Korea's economic relations and growth. The Korean won USD exchange rate is influenced by inflation, FDI, trade balance, and GDP growth. High inflation weakens the won, while FDI, trade surpluses, and economic growth strengthens it. Controlled CPI growth ensures currency stability. The graph shows inflation trends from 1983 to 2023. After high volatility in the 1980s, inflation stabilized at 1 to 4% until 2020 but surged to 8% by 2022 due to global disruptions. It is in 2023 but stay above pre-2020 levels.
Foreign direct investment greatly affects South Korea currency stability as seen from 1983 to 2023. Higher FDI inflow boosts economic growth, increased capital availability, and build investor confidence, leading to a more stable currency. In contrast, lower FDI level often happen with poor economic performance and higher currency fluctuations. This shows the important role of FDI in supporting South Korea economic strength and keeping its currency stable, while also showing its sensitivity to global economic changes and domestic policy. The official exchange rate has fluctuated significantly over the years. During the 1980s and 1990s, it remained mostly consistent, reflecting South Korea's early development and control policy. However, there has been significant adjustments in the late 1990s, especially after the 1997 Asian financial crisis and in 2050. This movement demonstrates the Korean won's sensitivity to external shock and its integration into the global financial system.
The table presents a regression analysis examining factors influencing South Korea's official exchange rate. The independent variables include inflation, foreign direct investment (FDI), net inflows, trade, and the consumer price index. The result shows that the trade has the most significant positive impact on the exchange rate, with an unstandardized coefficient of 21.567 at a highly significant p-value. The consumer price index negatively affects the exchange rate with a coefficient of negative 2.508 and a significant p-value, indicating its influence. However, inflation and FDI have insignificant effect, with p-value of 0.594 and 0.968 respectively. The constant value of negative 239.890 suggests a baseline exchange rate when all predictors are zero. These findings highlight the critical role of trade in shaping South Korea's exchange rate, while inflation and FDI appear to have a minimal impact.
The correlation table reveals important relationship between South Korea's key economic indicator, inflation, and the consumer price index show a moderate negative correlation, negative 0.335, suggesting that rising inflation disrupts price stability. Foreign direct investment and the exchange rate has exhibited a negative correlation, negative 0.336, indicating that higher FDI inflow often lead to a stronger, more stable currency. The strongest positive correlation is between the exchange rate and trade as a percentage of GDP, 0.955, showing how closely trade performance depends on currency fluctuations. Additionally, there is moderate positive correlation, 0.339, between CPI and FDI, suggesting that price stability can attract more foreign investment. This insight emphasizes the critical role of exchange rates, inflation control, and trade in shaping South Korea's economic resilience and growth.
The last one is ANOVA. The p-value for the f-test is less than 0.01, which is significantly below the level of significance, 0.05. Therefore, the null hypothesis is rejected. This means that the consumer price index, trade of the GDP, inflation, and foreign direct investment are statistically significant variables in explaining the variation in the official exchange rate. For the model summary, the value for R squared is 0.930. It means that approximately 93% of the exchange rate of Korean won is explained by the consumer price index, trade as a percentage of GDP, inflation, and foreign direct investment. The value for adjusted R squared value is 0.925. This shows that 92.5% of the variation exchange rate variability. The dependent variable is likely explained by the independent variable. Based on the analysis, the most significant factor affecting the official exchange rate of the Korean won is inflation. High inflation is directly weakens the won by reducing its purchasing power and competitiveness, while low inflation has stabilized the exchange rate. Trade as a percentage of GDP also plays a major role, as increased trade activity strengthen the economy and support the stability of the currency. Foreign direct investment (FDI) has a moderate impact, as highest FDI inflows boost financial stability and indirectly strengthen the won. Among these, inflation appears to have the strongest and most direct influence.